Assalamualaikum. My name is IZLEANI binti ASMADI. My metric number 052619. What is exchange rate? Exchange rate is the price of one currency in terms of another currency. Exchange rate can be either fixed or floating. Fixed exchange rate are decided by central banks of a country, whereas floating exchange rate are decided by the mechanism of market demand and supply. This is graph of $1 to Malaysian ringgit exchange rate from 1st January 2021 until 16 January 2021. As we can see, the graph up and down due to the factor that influence exchange rate. Next, factors that influence exchange rate. First, inflation, interest rate, political stability and economic performance, term of trade, government debt, last but not least, recession and speculation. First, inflation. A low inflation rate typically exhibits a rising currency value as its purchasing power increases relative to other currency. Conversely, countries with the higher inflation typically see depreciation in their currency compared to that of their trading partners, and is also typically accompanied by higher interest rate. Next, interest rate. Higher interest rate offer lenders in an economy a higher return relative to other countries. Higher interest rates attract foreign capital and cause the exchange rate to rise. Cutting interest rate, on the other hand, can lead to a depreciation of currency. Next, political stability and economic performance. A country with a low risk of political unrest is more attractive to foreign investors, drawing investment away from other countries perceived to have more political and economic risk. Foreign investors inevitably seek out stable countries with strong economic performance in which to invest their capital. Next, terms of trade. Terms of trade related to a ratio which compares export price of country to its import price. Increasing terms of trade indicate a greater demand for a country's export. The result is an increase in revenue from export, which has the effect of rising end demand for the country's currency and an increase in its value. Next, government debt. Countries with large public deficit and debt are less attractive to foreign investors and are thus less likely to acquire foreign capital, which leading to inflation. If market fear a government may default on its debt, foreign investors will forecast a rise government debt within a particular country. Last but not least, recession and speculation. Countries that experience a recession, its interest rates are likely to fall, and its chance to acquire foreign capital. Its currency weakness in comparison to that of other countries, therefore lowering the exchange rate. If a country's currency value is expected to rise, investors will demand more of that currency in order to make a profit in the near future. This increasing demand will cause the value to rise. That's all from me. Thank you.
Assalamualaikum. My name is IZZATI binti NASIR. My metric number is 052655. I want to talk about foreign exchange market and also nominal rate and the real exchange rate. Okay, first we will go to the definition of foreign exchange market. What is foreign exchange market? The foreign exchange market, also known as Forex, FX, or the currency market, is an over-the-counter global marketplace that determines the exchange rate for currency around the world. Thus, the foreign exchange market is the market for a national currency anywhere in the world as the financial center of the world united in a single market. Lastly is foreign exchange market are made up for bank, forex dealers, commercial company, and also central bank and investment management firm and investor. What is the benefit of using foreign exchange market? Okay, let me tell you. First is, there are fewer rules, which means investors are not held to the strict standard or regulation found in other markets. Second is, most investors not have to pay the fee or commission that you would have to another market. Third is, because the market is open 24 hours a day, so we can trade anytime. Four is, it can transfer finance, purchasing power from one nation to another. 5 is, it can provide credit for international trade, which is credit function. Lastly is, it can make provision for hedging facilities, for example to facilitate buying and selling, spot or forward. What is the definition of nominal rate? The nominal exchange rate, E, is defined as the number of units of the domestic currency that can purchase a unit of a given foreign currency. An increase in this variable is the nominal depreciation of the currency, while a decline in the value of one currency relative to another is called a depreciation of the currency that is falling in value. The rise in the value of one currency relative to another is called an appreciation of the currency that is rising in a value. Besides that, what is the definition of real exchange rate? The real exchange rate, R, is defined as the ratio of the price level abroad and the domestic price level, where the foreign price level is converted into domestic currency unit via the current nominal exchange rate. A decrease is R is term appreciation of the real exchange rate and increase is term depreciation. In practice, change of the real exchange rate rather than its absolute level are important. Next, we will go to the major foreign exchange market. We have spot market, which is the quickest transaction involving currency in the foreign exchange market. Next is forward market. A forward market is an over-the-counter marketplace that sets the price of financial instrument or asset for future delivery. Third is future market. There is an auction which participants buy and sell commodity and future contract for delivery on a specific future date. 4 is option market. There is a derivative market that is traded in contract. It is contract between buyer and seller. Lastly is swap market. There are customized contract traded in the over-the-counter market privately versus option and future traded on a public exchange. Next is the importance of the exchange rate. When the nominal exchange rate raises, import become more expensive and export become more cheaper to foreigner. The depreciation of currency can lead to higher inflation. Also, tradable goods can be sold more expensive abroad. After that is the nominal exchange rate also influence the flow of capital between countries and interest rate. It affects investment, economic growth, and also welfare of people.
Okay, hi and Assalamualaikum. My name is Nordin with the Rizal and I am from DIF. My metric number is 052611. So for today, I would like to present about foreign exchange in long run. There are two factors of foreign exchange in long run. The first factor is the law of one price. The second factor is purchasing power parity. Okay, the law of one price. The starting point for understanding how long-run exchange rate determined is the law of one price. The law of one price is predicated on the concept of arbitrage. Arbitrage is the idea that identical products should sell for the same price. The purpose for arbitrage is to require advantage of the difference in prices available for an equivalent financial instrument being offered on different exchanges. The law of one price exists because differences between asset prices in several locations would eventually be eliminated due to arbitrage opportunity. This law applies only in competitive market free of transport costs and official barriers to trade. For example, if the ringgit Malaysia exchange rate is 4 ringgit 5 cents per United States dollar, a sweater that sells for $45 in New York must sell for 182 ringgit 5 cents in Kuala Lumpur. Okay, next is purchasing power parity. Purchasing power parity is a popular metric used by macroeconomics analysts that compare different countries' currency through a basket of goods approach. A basket of goods refers to a fixed set of a consumer product and services whose price is evaluated on a regular basis, often monthly or annually. Purchasing power parity allows for economies to compare economic productivity and standards of living between countries. Some countries adjust their gross domestic product (GDP) figures to reflect purchasing power parity. To understand better how GDP pair with PPP works, suppose it costs $10 to buy a book in US and it costs 40 ringgit and 50 cents to buy an identical book in Malaysia. To make an apples-to-apples comparison, we must first convert the $10 into ringgit Malaysia. In other words, for every $1 spent on the book in the US, it takes 4 ringgit 5 cents to obtain the same book in Malaysia buying it with ringgit Malaysia. Okay, so now I would like to talk about the relationship between purchasing power parity and the law of one price. The law of one price applies to individual commodities, while purchasing power parity applies to the general price level. If the law of one price holds true for every commodity, purchasing power parity must hold automatically for the same reference baskets across countries. Proponents of purchasing power parity theory argue that its validity does not require the law of one price to hold exactly. The concept of law of one price asserts that if same goods enter each country's market basket, the purchasing power parity exchange rate should prevail between two countries to maintain the principle of one price despite the difference in currency. In summary, the theory of purchasing power parity derived from the law of purchasing power is useful in theory of product pricing and the determination of exchange rate currency. But as far as the limitation mentioned above is concerned, it should sensibly be considered as a guidance only rather than a direct application in real world. Okay, that's all from me. Thank you for watching. Okay, bye-bye.
Assalamualaikum warahmatullahi wabarakatuh. My name is NURNABILAH binti Nordin and my metric number is 052646 and I'm from Diploma in Finance, Semester 5. Today I'm going to present about exchange rate in the short run. I am using US dollars as for the example throughout this presentation. First of all is supply of dollars. Dollars are supplied by American households, firms, governments that wish to purchase goods, services, or financial assets denominated in the domestic currency. The money supply roughly includes both cash and deposits that can be used almost as easily as cash. Governments issue paper currency and coin through some combination of their central banks and treasuries. For instance, the supply of US dollars comes from American households and firms that wish to buy goods and services from European countries and American investors who wish to buy assets. Next is demand for dollars. The demand or outflow of dollars comes from domestic households, firms, and governments who wish to purchase goods, services, or financial assets that are denominated in the US dollars currency. For example, if a US auto importer wants to buy a German car, it must buy euros. This also applies to the purchase of US corporate stocks from non-US investors, which would require the foreign investor to sell their currency to buy dollars in order to purchase those stocks. In the equilibrium market, people can study how changes in an economy affect the exchange rate. The foreign exchange market involves firms, households, and investors who demand and supply currencies coming together through their banks and the key foreign exchange dealers. Figure above shows an example for the exchange rate between the US dollar and the Malaysian ringgit. The vertical axis shows the exchange rate for US dollars, which in this case is measured in ringgit. The horizontal axis shows the quantity of US dollars being traded in foreign exchange market each day. The demand curve for US dollars intersects with the supply curve. US dollars at the equilibrium point E. Next, what are the factors that affects the supply curve shifts to the right? So the first one is the increase in the real interest rate on foreign bonds, on which can attract the Americans to buy bonds. Second, the reduction in riskiness of foreign investment. As we all know, the lower risk, it can protect against the chance of any loss. And the third one is the increase in American wealth, and it allows the American to supply dollars to the market. And last but not least, the expected depreciation of dollar. This makes people does not want to keep the dollar, as the dollar contains a lower value than the other currency. Conversely, in the demand curve perspective, the increase in the real interest rate on US bonds can attract foreigners to buy the bonds. Second, the reduction in the riskiness of US investments that can protect against the chance of any loss. Third one is the increase in foreign wealth allows them to buy dollars in the market. Last but not least, the expected future dollar appreciation attracts foreign people to buy dollars as they held a greater value. Next, by using the expected depreciation of the dollar, I will explain on how the supply curve will shift to the right. From the figure, we can see that the exchange rate market reacts negatively to the expected depreciation of the dollar. The depreciation of the dollar makes US exports more competitive but raises the cost of importing goods into the US. A rise in expected depreciation of the dollar would lead supply to shift from S0 to S1. It will make investors more likely to supply dollars to the foreign exchange market. Okay, next, by using the increase in real interest rates, I will explain on how the demand curve will shift to the right. In general, a higher rate of return for US dollars makes holding dollars more attractive. So, from the figure, we can see that the demand for dollars in the foreign exchange market shifts to the right from D0 to D1. The new equilibrium E1 has a stronger exchange rate than the original equilibrium E0, and the equilibrium quantity traded shifts to the right. So that's all from me, the presenter of exchange rate in the short run. Thank you and have a great day.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Today I will present about government policy and foreign exchange intervention. Before that, my name is Nuraishyah binti AZMAN and I'm from Diploma in Finance. My metric number is 052664. First, I will brief what is the meaning of government policy. A government policy is a rule or principle that hopefully better guides decision resulting in positive outcome that enhance the community or unit. Government policies contain the reasons things are to be done in a certain way and why. This leads to the development of procedures and protocol to see that policies are conducted in an appropriate manner. as members of society, we all play important roles in the development of government policy. From the president of your class to the lowest level of public office to the presidency of the United States, our power to vote determines that who makes policy and how that affects our life and the community. Okay, next. A foreign exchange intervention is a monetary policy tool used by a central bank. When the central bank takes an active, participatory role in influencing the monetary funds transfer rate of the national currency, it usually does so with its own reserve or its own authority to generate the currency. Central banks, especially those in developing countries, intervene in the foreign exchange market in order to build reserve for themselves or provide them to the country's bank. Their aim is often to stabilize the exchange rate. When a central bank increases the money supply through its various means of doing so, it must be careful to minimize unintended effects such as runaway inflation. The success of foreign exchange intervention depends on how the central bank sterilizes the impact of its intervention as well as general macroeconomic policies set by the government. Foreign exchange intervention comes in two flavors. Firstly, a central bank or government may assess that its currency has slowly become out of sync with the country's economy and is having adverse effects on it. For instance, countries that are heavily reliant on export may find that their currency is too strong for other countries to afford the goods they produce. They may intervene to keep the currency in line with the currency of the country which export their goods. One example of this kind of intervention occurred by the Swiss National Bank from September 2011 until January 2015. The Swiss National Bank set a minimum exchange rate between the Swiss francs and the euro. This kept the Swiss franc from strengthening beyond an acceptable level for other European importers of Swiss goods. This was successful for 3.5 years, but the Swiss National Bank determined that it had to let the Swiss francs float freely and without prior warning, they released the minimum exchange rate. This had highly negative consequences to some businesses, but generally the Swiss economy has been unfazed by the intervention. Secondly, intervention can be a short-term reactionary to a certain event. Oftentimes, one-off event may cause a country's currency to move in one direction in a very short space of time. Central bank will intervene with the sole purpose of providing liquidity and reducing volatility. After the Swiss National Bank lifts the floor in its currency against the euro, the Swiss francs plummeted by as much as 25%. The Swiss National Bank intervened in the short term to stop the francs from falling further and curb the volatility. Okay, last but not least, foreign exchange intervention can be risky in that they can undermine a central bank's credibility if it fails to maintain stability. Defending the national currency from speculation was a precipitating cause of the 1994 currency crisis in Mexico and was a leading factor in the Asian financial crisis of 1997. So, what I can conclude in this chapter is policy making is the process of taking an idea and transforming it into an action. And those ideas come from people like us. Our potential to influence policy development does not end at the voting booth. Every one of us has the power to affect policy. Our voices and action can be heard by being actively involved in community groups and voicing our concerns. Although foreign exchange may be confusing in today's global marketplace, there is a critical need for almost everyone to understand foreign exchange like never before. So that's all from me. Thank you.